Common and preferred stock. Most of you know that corporations issue stock, sometimes multiple versions of different voting rights, and sometimes preferred stock, sometimes more than one with different dividend payments. One could elect to receive the certificate, maybe putting it in a safety deposit box, or better, place it with an SIPC, Securities Investor Protection Corporation, registered broker, where it's more easily available during an emergency, and you can borrow against it. Stocks can pay high or low dividends with the resulting opposite effect upon their growth. High dividend stocks have low growth and vice versa. Corporations issue common stock, sometimes more than one with different voting rights, and may also issue preferred stocks, sometimes in varying amounts of dividends. The common stock gets a vote. The preferred stock, given its preference, has no vote. Common stocks may or may not have what's called cumulative voting, and preferred stocks may or may not have what's called cumulative dividends. In the case of cumulative voting for common stock, the number of votes are equal to the number of shares times the number of officers and assures minority representation. Let's look at an example. Suppose I have 50 shares and my students have 30 shares, and there are 4 officers. Each one gets to vote the number of shares times the number of offices. I'd have 200 votes. Students would have 120 votes to allocate among, say, a total of 8 candidates. I could vote 50 each for 4 of my candidates, but they could allocate their 120 votes among 2 candidates and still assure minority representation, and also allows due deliberation and visibility. Returning to cumulative dividends for preferred shares, it just says they may have the provision that the preferreds get paid first and may accumulate over time. That's called arrearages. Well, we academics sure do love our proofs, so do bear with me. It actually gets quite simple. Stock is valued as the stream of dividends, usually forever, at some discount rate. And we could compute a growth-adjusted discount rate forever, and that's a perpetuity, the reciprocal of the discount rate. Here I'm going to call that Z. And if we solve it through substitute, we get what's called the Gordon growth model, or the discounted cash flow model for common stock. Here's an example. Suppose the current dividend is $3, discount rate is 10%, stock's growing at 4%, then you would have, the next period dividend would be $3.12 divided by the difference between the discount rate and the growth rate, 0.06, which is $54. I made a little graphic to make this a little bit more visible. See, the corporation has assets at time 0, making rate of return achieved R. That makes earnings for the next period. And you split them off in either to dividends, which are paid out, or to reinvest, which increases the growth rate of the firm by the growth rate G. Now, an advanced analysis, you can bear with me if you like or skip, is we can disaggregate all of this. If B is the retention rate, then 1 minus B is the payout ratio, and it's really simple to compute. It's the PE times the dividend yield because the prices cancel. This is dividends comes from earnings times the payout ratio. The earnings come from the achieved rate of return on the assets. And growth is the amount of the retention rate times the achieved rate of return. And, of course, we have an example. Let's say assets are 100, earning 10%. Earnings thus must be $10. The retention rate is 60%. That means the payout ratio is 40%. And the discount rate is 8%. Well, if the achieved rate of return is 10% and they are retaining 60%, then they're growing at 6%. Thus, we have earnings of 10, payouts 40%, so the dividends are 4. It's growing at 6%, so we can calculate it through and get 200. Notice that's twice the nominal asset value, which makes sense because the company is making more than the required rate of return. Well, why is that possible? Well, they may have patents, a great location, brilliant chefs or actors, writers, producers, and or what's sometimes called a moat. They can do something no one else can. But one might expect in the long run that moat may be crossed. They will face competition, or the losers will leave, and you might see equilibrium where the discount rate equals the achieved rate of return. And you'll see, it's easy to prove, then the price will equal the nominal asset value. On the other hand, the residual theory of dividends says, well, if the company achieves more than its discount rate, then it's valued above nominal assets, and they would be further increased. Lower dividends and payout ratios, higher growth rates and retention rates, and vice versa. By the way, let's take that valuation model, divide by the earnings. That gives us a price-earnings ratio, which in equilibrium turns out just to be the reciprocal of the discount rate, and that means it goes the opposite rate of inflation and interest rates. And here's a graph to show that that's generally true. A final consideration, kind of counterintuitive until you think about it, is what would be the return to any security, regardless of whether it's trading at a premium or a discount, with either optimal or non-optimal dividend growth retention policies. And that is, interestingly, here's the proof, you get back the discount rate. Keeping you up to date with Dr. C.